Before redlining had a name, black families already had an answer. They pooled coins in a circle, took turns receiving the full pot, and called it by names carried across the ocean. They paid premiums to an insurance company in Durham, North Carolina, and that company turned around and offered them a mortgage. They saved in the back rooms of barber shops and beauty parlors, in the collections of fraternal lodges, in the quiet discipline of domestic workers who spent decades cleaning other people's homes so they could one day own their own. They built an entire parallel economy out of the belief that the door the bank had locked was not the only door. Some of what they built lasted generations. Some of it was taken from them by violence, by law, or by fraud. All of it was real. 25 ways. 25 answers to a wall that was never supposed to have one. This is where the money actually came from. Section 1. The wall that was built around the middle of the 20th century. Buying a home in America was, for most white families, a matter of paperwork. A man walked into a bank, filled out a form, and walked out with a loan. The process was not always easy, and the terms were not always generous, but the door was open, and he was allowed to step through it. For most black families during those same decades, the door was not merely locked. In many cases, it had been bricked over entirely, and the bricklaying had been done by the federal government itself, in broad daylight, using public money. Understanding what black families managed to build outside the formal banking system requires understanding, first, what the formal banking system did to them. The story begins not with private prejudice alone, though there was plenty of that, but with a deliberate architecture of exclusion built into the structure of American law, federal policy, and institutional finance across several decades in the 20th century. After the Civil War ended and the brief hope of Reconstruction faded, black families across the country found themselves free, in a legal sense, but locked out of the mechanisms by which most Americans built economic stability. Land was the most fundamental of those mechanisms, and black families were largely denied it from the start. The promise of 40 acres and a mule, which would have given formerly enslaved people a foothold in land ownership, was reversed by presidential order almost immediately, and the Homestead Act, that gave away millions of acres of western land to white settlers, produced only a few thousand black homesteads. By the time the 20th century arrived, black families were already starting from a position of deep structural disadvantage, and the government policies that followed would make that disadvantage considerably worse. The most visible piece of that architecture was the system that came to be known as redlining. In the 1930s, a federal agency called the Home Owners Loan Corporation was created to help stabilize the mortgage market during the Great Depression. As part of its work, it produced detailed maps of neighborhoods in more than 200 American cities, grading each area for what it called residential security. The grading system used 4 levels, marked by colors. Neighborhoods deemed the best investment were colored green. Those considered the most hazardous were outlined in red. In nearly every city where these maps were drawn, black neighborhoods landed in the red zone, regardless of the actual quality of the housing or the reliability of the people living there. The agency's own written descriptions of those neighborhoods made the reasoning plain. The presence of black residents was itself the stated reason for the low grade. The maps did not hide this. They wrote it down. The consequences reached far beyond the agency that drew the maps. Private banks, savings institutions, and insurance companies used similar thinking to guide their own lending decisions, often refusing mortgages to black applicants or to anyone seeking to buy in a black neighborhood. The Federal Housing Administration, created in 1934, provided government insurance for home loans, but actively discouraged and in many cases refused to insure mortgages in black neighborhoods, giving private lenders a federal seal of approval for their existing discrimination. Its own underwriting manual, at various points, explicitly warned against neighborhood racial mixing and recommended the use of restrictive covenants to preserve the racial character of the areas it would insure. By one widely cited estimate, approximately 98% of the home loans guaranteed by the FHA between 1934 and 1962 went to white families. Then came the GI Bill, signed into law in 1944, The Servicemen's Readjustment Act offered returning veterans low-cost home loans, college tuition, and a path into the growing middle class. It was one of the most powerful wealth-building tools in American history. For white veterans, it worked exactly as intended. The great post-war suburban expansion was built largely on these loans, and the families who bought those homes watched their property values grow for decades. For black veterans, who had served their country in the same war, the bill existed on paper, but not in practice. The VA could guarantee loans, but not issue them directly. That task fell to private banks and local lending institutions, and those institutions, particularly in the South but also across the North, refused to extend mortgages to black veterans under the same conditions they offered white ones. Black veterans were steered away from four-year colleges, denied access to the new suburbs being built with federal support, and left to navigate a housing market that had been structured, at every level, to keep them out. The suburbs that grew from those post-war loans became white communities almost by design. Developers like William Levitt built massive planned communities and explicitly refused to sell to black buyers, a policy he stated openly and defended publicly. The deed restrictions that governed many of these new neighborhoods contained racial covenants, legal language written into the titles of individual homes that prohibited the sale or rental of the property to black families. The Supreme Court ruled such covenants legally unenforceable in 1948, but the neighborhoods they had already created did not change overnight, and the informal pressure to maintain racial boundaries did not evaporate with a court decision. What all of this produced was a two-track system of homeownership, running in parallel across the same country at the same time. White families accumulated equity, passed land down through generations, and used the wealth stored in their homes to fund education, businesses, and the next generation's start in life. Black families were largely locked out of that process, paying rent to landlords rather than building equity, or purchasing on deeply unfavorable terms when they could purchase at all. The racial wealth gap that exists today is, in significant part, the compounded result of those decades of exclusion. But exclusion was never the whole story. Alongside everything described above, black families and communities were building their own systems, finding their own paths, pooling their own resources, and getting their people into homes through methods that owed nothing to the institutions that had turned them away. The 25 stories that follow are those methods and the people behind them. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. That is the wall that was built against black homeownership. Now comes the part that the wall's architects did not account for: what black communities built in response. The next story goes back to West Africa, to a savings practice older than any American bank that crossed the ocean in the memory of enslaved people and quietly helped families buy homes for generations afterward. Section 2. The Saw-Saw, saving together across the ocean. Long before there were banks in the modern sense, there were circles. A group of people who trusted one another would agree to put a fixed amount of money into a shared pot on a regular schedule, and each week or each month, one person in the circle would receive the whole sum. Then the next person, then the next. The pot rotated around the group until everyone had received their turn, and then it started again. No interest, no application, no credit check, no institution of any kind standing between the members and their money. Just an agreement between people who knew each other and counted on each other to keep their word. This practice has existed in one form or another across West Africa for centuries, and it traveled across the Atlantic in the memory of enslaved people. Scholars who study it note that it goes by more than 200 different names around the world. In Trinidad and parts of the Caribbean, it became the so. In Jamaica, it was known as a partner. In Guyana, a box hand. In Haiti, a min. In parts of Nigeria, and among the Yoruba people, the original term was esusu, meaning, in rough translation, saving money little by little. The concept is the same in every case, even when the name changes with the geography. The mechanics are simple enough that a group of neighbors can set one up in an afternoon. Say 10 people each agree to contribute $100 every 2 weeks. Every 2 weeks, the entire pool of $1,000 goes to one member of the group, in a rotation that the group decides in advance. The person who receives the money first has effectively gotten an interest-free advance, which they will repay through their future contributions. The person who receives it last has effectively been saving in a disciplined, structured way, with the added incentive that the whole group depends on their reliability. The organizer, sometimes called the banker of the circle, keeps the records and collects the contributions, occasionally receiving a small acknowledgement for the effort. What made this system valuable for Black families navigating a discriminatory housing market was the lump sum it produced. A down payment, even a modest one, was often the single most difficult obstacle between a family and a home. A family might be able to cover monthly payments, might have stable income and a good rental history, might by every honest measure be a sound candidate for homeownership, and still find that the initial sum required at closing was simply out of reach when accumulated penny by penny from a single household budget. The Susu solved that problem by spreading the saving across a community and concentrating it for each member in turn. The practice was especially strong among communities with roots in the Caribbean and West Africa. Scholars who have studied it in New York City have noted that Susus were operating by the thousands within West Indian communities in Brooklyn, with rotating pools that ranged from small, intimate circles to larger groups with payouts in the tens of thousands of dollars. A researcher at Williams College who studied the system in that community described it as having 1 foot in economic survival and 1 foot in cultural identity, a financial mechanism that was also a form of belonging. Among the participants, the system was understood not as an informal workaround, but as a legitimate and serious financial practice, with its own discipline and its own ethics. That discipline rested entirely on trust, and trust rested on the nature of the relationships within the group. Susus were typically formed among family members, close friends, co-workers, or members of the same congregation or community organization. The absence of any legal contract was not a weakness in the system, but a feature of it, because it meant membership was self-selecting. People who could not be trusted to contribute were not invited, and people who were invited understood that their reputation and their relationships were on the line every time they paid in. Default in a Susu was not simply a financial transaction gone wrong. It was a breach of community trust, with social consequences that mattered as much as any legal penalty. There is no comprehensive historical record of how many Black families used Susu proceeds specifically for home purchases, because these arrangements were informal and left no paper trail. But the accounts that do survive, in oral histories and in the stories passed down within families, make clear that the practice was used for exactly this purpose across generations. A woman who had been contributing faithfully to a circle for 2 years would receive her turn and use the sum as a down payment. A family that had spent years unable to accumulate savings fast enough in a single account would find that a Su, by creating a structured and socially reinforced obligation to save, produced the lump sum that a looser intention to set money aside never quite managed to. The system was not without risk. The most significant danger was the person who received their turn early and then stopped contributing, effectively taking from the pool without completing their obligation to the rest. This happened, and when it happened, it fell hardest on the members who had not yet received their payout. Genuine Susaus, built on real trust and real relationships, managed this risk through the same mechanism that made them work in the first place: the weight of community accountability. The practice has persisted into the present day, and in some communities it has moved to digital platforms while keeping its essential character intact. What it represents, stripped to its core, is the oldest financial principle in human experience: that people who pool their resources can each achieve things none of them could have reached alone. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. The Soso carried an African tradition of collective saving across centuries and an ocean, turning community trust into purchasing power, one rotation at a time. The next story reaches back even further into the American record, to the first formal organizations that free black people in the early United States built to take care of one another, and how those organizations quietly planted the seeds of black homeownership long before the word redlining existed. Section 3. Mutual Aid Societies, and the First Architecture of Self-Help. Sometime in 1787, in Philadelphia, a group of free black men gathered and formed an organization they called the Free African Society. The men behind it included Richard Allen and Absalom Jones, both of whom had been enslaved and had purchased their own freedom. What they built together was not a church, though it would eventually give rise to one. It was not a bank, though it would eventually perform some of the functions of one. It was a mutual aid society, and it was built on a single organizing idea, that people shut out of the institutions of the wider society would have to build their own. The Free African Society collected dues from its members, and used the pooled money to provide for widows, orphans, and the sick. It maintained records of marriages. It established the first African American cemetery in the city. Within a few years, similar organizations had appeared in other northern cities. The African Union Society in Newport, Rhode Island, the African Society in Boston, the African Humane Society in Philadelphia, the African Society for Mutual Relief in New York. By 1837, one account in the black press reported that 55 mutual aid societies had incorporated in Philadelphia alone, and that count likely missed many that operated informally and never sought official recognition. These early societies were, at their foundation, burial clubs. The importance of a proper funeral was deeply felt in African cultures, and the earliest organizations formed specifically to ensure that members would not be left in an unmarked grave. But burial clubs have a logic that tends to expand. Once a community has pooled enough money to bury its dead with dignity, it has demonstrated that collective saving works. And the question naturally follows, what else can it do? Across the 19th century, the answer grew to include sick benefits, small loans, support for members who had lost work, and eventually something much closer to what we would now recognize as financial services. The fraternal orders that developed alongside the mutual aid societies extended this logic further and gave it structure and scale. The Prince Hall Masons, chartered in 1784, became the oldest and eventually the largest black fraternal organization in the country, growing to hundreds of thousands of members across thousands of lodges by the early 20th century. The Grand United Order of Oddfellows, established in 1843, reached a membership of around 300,000 at its peak. The Knights of Pythias, the Order of the Eastern Star, the Independent Order of St. Luke, and a range of other fraternal bodies, each operated their own networks of mutual support, collecting dues, and redistributing them to members in need. Burial societies established funeral homes, cemeteries, and in some cases, banks and real estate companies. What these organizations provided that banks and insurance companies would not was access without discrimination. A black man who walked into a white-run bank in 1890 was likely to be turned away or offered terms that made the transaction barely worth having. A black man who joined a fraternal lodge paid his dues and was entitled to its benefits on the same terms as any other member. The organizational structure created a form of financial inclusion that operated entirely outside the institutions that excluded black people, and it did so on a large enough scale that it shaped entire communities. For homeownership specifically, the mechanism worked in several ways. The small loans that mutual aid societies made to members in difficulty could prevent a family from losing a home they had already managed to acquire. The savings habits, reinforced by the regular payment of dues, built the discipline that made larger purchases possible over time. The networks of trust and relationship that the fraternal orders maintained meant that when a member needed capital for a major purchase, he or she had a community of people who knew them personally and could vouch for their reliability in ways that no credit score had yet been invented to measure. There was also something less tangible but no less real, which was the demonstration effect. When an organization collectively owned property, when a lodge built its own hall, or a mutual aid society purchased a piece of land, it showed the community what was possible. In Boley, Oklahoma, a town built by black settlers at the turn of the 20th century. The Prince Hall Masons constructed a Masonic temple that was reported to be the tallest building between Oklahoma City and Okmulgee. That building was not just a meeting place. It was a visible proof that black collective resources could build something that lasted. The mutual aid tradition did not end with the 19th century. It fed directly into the institutions that followed: the credit unions, the black-owned banks, the building and loan associations that would carry the work forward into the 20th century. The Free African Society of 1787 and the insurance company founded in Durham in 1898 belong to the same continuous line of thought, that when the door is shut, you build your own. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. The mutual aid societies were the roots from which everything else grew, a living proof that collective resources and community trust could substitute for institutions that refused to serve everyone. The next story follows those roots into the place where they found their deepest soil, inside the walls of the Black Church, which became something no one had officially designed it to be: a financial institution. Section 4. The Black Church as a financial institution. There is a line that has been repeated in various forms across Black American history, and it goes something like this: the Black Church was never just a church. It was the first community center, the first school, the first meeting hall, the first safe space, and, in ways that rarely appear in formal financial histories, something very close to the first bank. The role was not designed. It emerged, gradually and out of necessity, from the particular position the church occupied in Black community life. After the Civil War, Black congregations were among the only stable institutions in communities that had been systematically denied access to everything else. The church owned property at a time when Black individuals found it nearly impossible to hold title to land. It collected money every week through structures that no outside authority could easily reach or disrupt. It maintained relationships of trust that crossed the lines of income and occupation, binding together the domestic worker, the school teacher, the small business owner, and the day laborer under a single roof and a shared sense of obligation to one another. Those relationships, over time, became financial instruments. What made them powerful was that they operated on a form of underwriting that banks had no interest in performing. A bank assessed a borrower by the numbers on a page. A congregation assessed a member by decades of direct observation. They knew who showed up when things were hard. They knew who had quietly helped a neighbor through a rough season without being asked. They knew whose word was worth something when there was nothing else to offer as collateral. That knowledge, accumulated over years of shared life, was a kind of credit system that formal finance had never bothered to build for Black Americans, and could not have replicated if it had tried. When a family in the congregation faced the prospect of losing a home they had managed to acquire, a collection was often taken up. When someone needed a lump sum to make a purchase they could not otherwise reach, the community pooled what it could, and the arrangement that followed reflected what the borrower could actually manage, rather than what an institution's fixed payment schedule demanded. The terms were set by people who knew the borrower's circumstances from the inside, not by a formula applied from outside. The church also functioned as a guarantor of character in a world where formal credit histories either did not exist for Black families or were routinely ignored by discriminatory lenders. A pastor's letter confirming that a congregant had been a faithful, honest, and contributing member of the community for 20 years carried genuine weight within the networks where Black home ownership transactions actually took place. It could open doors that no credit score, had such a thing existed in its modern form, would have been allowed to open. Within Black communities, a pastor's endorsement of a family's trustworthiness was understood as meaningful testimony, and people acted on it accordingly. Some congregations went considerably further, creating explicit lending structures within the church's own financial life. Collections designated specifically for housing assistance, revolving loan pools governed by deacons or boards of trustees, and coordinated saving programs tied to the congregation's annual financial calendar all appeared in different communities at different times across the country. These were not improvisations thrown together in a moment of need. They were deliberate, ongoing mechanisms that some churches maintained for years, quietly cycling money through the community and helping one family at a time reach a closing table they would never have found through a bank. The Underground Railroad of the 19th century had been funded in part through black church networks. The civil rights movement of the 20th century was organized from black church buildings. It should not surprise anyone that the church also served, in the decades between and beyond those moments, as a quiet engine of home ownership. The institution that sheltered everything else also sheltered this. One thread of that tradition surfaced visibly in recent decades when a congregation in the California Bay Area created a formal fund to help black first-time buyers with down payments through interest-free loans to be repaid only when the home was later refinanced or sold. The congregation set an initial fundraising goal of $50,000 and quickly raised more than $300,000, with contributions coming in from other churches, community organizations, and individuals across the region. 21 families bought homes as a direct result. The mechanism was modern in its paperwork, but the impulse behind it was as old as the first tithing plate passed down a pew in a city where no bank would answer the knock at its door. What the black church provided, across all of these forms, was not charity in the diminished sense of that word. It was community capital, deliberately pooled and deliberately directed toward the single most powerful wealth-building tool available to an ordinary family in 20th century America. That it flowed through collection plates and deacon committees rather than through mortgage applications and loan officers did not make it any less real, and it did not make the homes it helped to build any less solid. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. The church held the community together, and sometimes held the down payment too, turning weekly tithes into keys to the front door. The next story moves from the congregation to the counting house, into the small but determined world of black-owned building and loan associations that gave families a formal path to a mortgage when every other formal door was closed. Section 5. Black Building and Loan Associations. Booker T. Washington noticed something in the numbers coming out of Virginia toward the end of the 19th century. He was looking at the question of how black families in the state had managed to become homeowners at all, given that virtually every formal institution of credit had been arranged to work against them. What he found, when he traced the money back to its source, was that roughly half of the homes owned by black Virginians had been built or purchased using loans from minority-owned building and loan associations. He wrote about it with something close to admiration, calling these institutions the most numerous and popular form of cooperative business his people had engaged in. W.E.B. Du Bois noticed the same thing in Philadelphia and drew the same conclusion. These small, member-owned lending cooperatives were doing what banks refused to do, and they were doing it with remarkable effectiveness. The Building and Loan Association was not a black invention. The model originated in the early 19th century as a cooperative arrangement in which working people pooled their savings and took turns borrowing from the common fund to build or purchase homes. By 1893, there were nearly 6,000 such institutions operating across the United States, serving communities that the established banking system treated as too small or too marginal to bother with. But those white-run associations, like most financial institutions of the era, drew a color line. Black families who needed mortgage financing could not walk into these organizations and expect to be served. So black communities built their own. By 1930, historical research has established that there were 73 black-owned building and loan associations operating across the country, concentrated heavily in cities where the Great Migration had brought large numbers of black families from the South in search of work and stability. Philadelphia, which had a long tradition of the thrift industry and called itself the City of Homes, accounted for nearly half of all the minority-owned thrift institutions in the country. The timing was not accidental. As cities like Philadelphia, Chicago, Detroit, and Cleveland saw their black populations grow rapidly in the first 2 decades of the 20th century, the demand for home financing within those communities outstripped everything the existing institutions, such as they were, could provide. Black-owned thrifts filled that gap. These institutions were smaller than their white counterparts, often by a significant margin. The average black-owned building and loan association of the early 20th century held assets roughly a tenth of the size of the average white-run institution. But size was not the measure of what they accomplished. What mattered was the relationship between the institution and the people it served, and in that dimension, the black-owned thrift operated on entirely different terms from anything a mainstream lender offered. Membership was the foundation. To borrow from a building and loan association, a person first had to save with it, often for an extended period, demonstrating reliability through the regular deposit of dues before any loan would be considered. This structure was actually familiar to black families who had already been participating in susaws and mutual aid societies, because it rested on the same logic: prove yourself through consistent participation, and the community's resources become available to you. The black-owned thrift formalized that logic and gave it a legal structure, a set of books, and a board of directors. One example that illustrates what these institutions could do over time comes from Cincinnati, where a man named Horace Sudduth founded the Industrial Savings and Loan Corporation to serve the black community of Walnut Hills. The institution grew steadily and survived the stock market crash of 1929 and the Great Depression that followed, a period when bank failures swept the country and mortgage delinquencies reached catastrophic levels, even in supposedly desirable neighborhoods. Historical records of delinquency rates in Cincinnati during the Depression show something the federal government's own appraisers chose to ignore. The neighborhoods they had labeled hazardous and colored red on their maps were actually repaying their loans at higher rates than the green-coded neighborhoods deemed the best investment. Sudduth's institution, serving black borrowers the mainstream market had written off, remained solvent through the worst financial crisis in American history. In 1953, it became the first black-owned savings and loan in Ohio to receive a federal charter, a recognition that arrived decades after it had already proven what it was capable of. In the late 1940s, black-owned thrifts around the country formed their own trade association to advocate collectively for minority homeownership and to press federal regulators for fairer treatment. The effort produced few dramatic victories in legislative terms. The machinery of exclusion was deeply embedded, and the levers of power were not easily moved. But the association's existence was itself a statement, a formal declaration that these institutions understood their purpose and intended to pursue it, whether the wider system cooperated or not. What the building and loan associations provided, in the end, was something simple and something that proved surprisingly difficult to obtain any other way: a place where a black family could save reliably, borrow on fair terms, and work their way toward a deed without first having to prove their humanity to an institution that had already decided it did not recognize their standing. They walked in as members and were treated as such. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. The black building and loan associations showed that a community could run its own mortgage market, on its own terms, and do it soundly. The next story moves to the institutions that grew alongside them, the black-owned banks that rose by the dozens in the decades after emancipation, and what they managed to build for the families who walked through their doors. Section 6. Black-owned banks and the Capital Savings Bank banking, as an idea, arrived in Black America under complicated circumstances. The first major institution designed specifically to hold black savings was not black-owned at all. The Freedmen's Savings and Trust Company, chartered by Congress in 1865, was created to serve the financial needs of formerly enslaved people and the black soldiers who had fought in the Union Army. At its height, it operated 37 branches across 17 states, and Washington collected deposits from tens of thousands of black savers and represented something genuinely new in American life: a formal financial institution built around the premise that black people's money deserved the same safekeeping as anyone else's. It collapsed in 1874. The bank's white managers had moved depositor funds into speculative investments, and when the financial panic of 1873 struck and real estate values fell, there was almost nothing left. More than 60,000 depositors lost the bulk of what they had saved. Congress eventually authorized reimbursement of up to 62% of losses, But many depositors received far less than that, and some received nothing at all. The institution that had been chartered by the federal government to help black families build financial security had instead stripped them of what little they had managed to accumulate. The collapse left behind something that lasted far longer than the bank itself: a deep, rational, generational distrust of financial institutions among black communities, a distrust that researchers at the University of Chicago have since linked, through careful historical analysis, to banking behavior in those same communities more than a century later. What rose in the wreckage was something different. This time, black communities built banks that they themselves controlled. The Capital Savings Bank, established in Washington in 1888, is widely recognized as the first black-owned bank in the United States. It did not survive long, closing within a few years, but it pointed the way. Between 1900 and 1934, sources tracking the period document that approximately 130 black-owned banks were established across the country. They appeared in cities and in smaller towns, in the North and in the South, serving communities that white-run financial institutions either ignored entirely or exploited when they could not be ignored. These banks operated under considerable constraints. Their depositor base was limited to black communities whose members had, on average, far less accumulated wealth than white depositors. Their lending portfolios were concentrated in neighborhoods that the federal government's own appraisal systems had declared hazardous, which made it difficult to access the federal backing and insurance programs that gave white-run institutions an enormous structural advantage. They competed for customers against larger, better capitalized institutions while working with a fraction of the resources. And yet many of them did the essential work they were built to do, which was to take in the savings of working black families and lend that money back to those same families in the form of mortgages and business loans. The geography of black banking followed the geography of black population. Durham, North Carolina, which had built a concentration of black businesses dense enough that it earned comparisons to Wall Street, was home to the Mechanics and Farmers Bank, founded in 1908 as a direct outgrowth of the same circle of entrepreneurs who built the North Carolina Mutual Life Insurance Company. The bank survived the Depression, survived the upheavals of the mid-century, and continued operating into the modern era, one of the longest-lived black financial institutions in American history. In Atlanta, similar institutions served a black professional and business class that had built a community of considerable economic depth along Auburn Avenue, a stretch that became known as the richest Negro street in the world at its peak. What these banks provided, that no white-run institution would reliably offer, was a fair hearing. A black family that walked into a white bank seeking a mortgage in 1920 or 1940 could expect to be turned away, or offered terms that reflected not their creditworthiness but the color of their skin. A black family that walked into a black-owned bank walked into an institution whose survival depended on accurately assessing the real creditworthiness of its community and lending accordingly. The incentive structure was entirely different, and so were the outcomes. The number of black-owned banks declined significantly after the Civil Rights era, as desegregation opened mainstream institutions to black customers and drew depositors away from community banks. The same dynamic that had made black banks necessary, the captive market created by segregation, dissolved when the legal walls came down, and the institutions that had served within those walls found themselves competing on unequal terms in a newly opened market. Many did not survive that transition. Those that did continued to serve communities that the mainstream market still underserved, operating on the same principle that had founded them, that a community's money, cycled back through institutions that community controlled, could build something that outside capital never would. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. Black-owned banks put community capital back into community hands, but they were never the only instrument available. The next story travels back before any of those banks existed, to a moment of catastrophic institutional betrayal that shaped black financial behavior for generations, and to the lessons black families quietly drew from it about where money could and could not safely be trusted. Section 7. The Freedmen's Bank. The collapse, and what was learned. Some failures are so complete, so perfectly designed to destroy trust at its root, that they shape the behavior of entire communities for generations afterward. The collapse of the Freedmen's Savings and Trust Company in 1874 was that kind of failure. It did not merely wipe out the savings of tens of thousands of black depositors. It taught a lesson that traveled through families and communities long after anyone who had personally lost money in its branches had died. And that lesson was simple and devastating. The institution that smiles at you and takes your money is not necessarily the institution that will protect it. The bank had opened in 1865 with genuine promise. It was chartered by Congress, carried the implicit backing of the federal government, and was promoted aggressively through black churches and community networks as a safe and honorable place for black families to deposit their earnings. The moral framing that surrounded it was deliberate. Bank officials and their advocates presented saving as a mark of respectability and self-improvement, and the bank as the proper vessel for that aspiration. Black soldiers who had risked their lives in the Union Army were encouraged to deposit their pay. Freed people who had just emerged from slavery and were building economic lives from nothing were told this was the responsible thing to do. Tens of thousands of them believed it, and they saved faithfully. At its height, the bank held assets worth more than $3.5 million in the currency of the time. 37 branches reached across 17 states. The records that survive describe ordinary working people making small, regular deposits, nickels and dimes accumulating over months and years into something that represented, for many families, the entirety of their financial security. Then the management, which was dominated by white officials throughout the bank's existence, despite the institution's stated purpose, began moving those deposits into speculative investments, including loans connected to real estate ventures that proved far riskier than the bank's conservative mandate required. When the financial panic of 1873 hit and real estate values collapsed, there was almost nothing recoverable. Frederick Douglass was brought in as president in a last attempt to restore confidence, but he quickly understood the scale of what had happened and turned to Congress for help. On the 29th of June, 1874, the trustees voted to close the bank. More than 60,000 depositors were left with losses totaling close to $3 million. Congress authorized a reimbursement program that promised to cover up to 62 cents on the dollar, but many depositors received considerably less than that, and some received nothing at all. No one in a position of responsibility was ever prosecuted. What followed the collapse was not simply grief and anger, though there was plenty of both. What followed was a rational recalibration of trust. Black communities that had watched their savings disappear through an institution the federal government itself had chartered did not emerge from that experience with a strengthened belief in the value of formal banking. They emerged with a confirmed understanding that formal institutions could fail them, could be manipulated against their interests, and offered no guarantee that what they deposited would ever come back. That understanding, passed down through families and reinforced by subsequent experiences with discriminatory lending and predatory financial practices, produced a lasting pattern of caution toward mainstream financial institutions that researchers studying black banking behavior well into the 20th and even 21st century have documented as a measurable legacy of 1874. But the response to the collapse was not only withdrawal, it was also redirection. The energy and the savings that might otherwise have flowed into formal banking institutions went instead into the parallel systems that black communities had already been building and would continue to develop. The mutual aid societies, the fraternal orders, the susus, the black-owned building and loan associations, the church funds, and the informal lending networks, all of these became more important, not less, in the decades after the Freedmen's Bank closed its doors. They offered something the failed bank had not: accountability to the community itself, rather than to distant managers whose interests did not align with those of the depositors. There is a particular irony in the fact that the institution designed to bring black Americans into formal financial life ended up deepening their reliance on informal and community-based alternatives. But that irony contains its own form of resilience. The systems black communities built in response to exclusion and betrayal were not consolation prizes. They were functional, durable, and in many cases, more reliably aligned with community interests than anything the mainstream market offered. The Freedmen's Bank did not destroy black financial ambition. It redirected it toward institutions that black communities owned and controlled themselves. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. The collapse of the Freedmen's Bank deepened distrust of outside institutions and pushed black communities further toward the financial structures they controlled themselves. The next story follows that momentum into one of the most remarkable and least known chapters in black economic history, the black-owned life insurance companies that quietly became some of the most important mortgage lenders available to black families in the first half of the 20th century. Section 8. Black life insurance companies and the mortgage nobody else would write. Somewhere in the mid-1950s, a black man named F.D. Wharton sat down and wrote a letter of complaint to a large New York life insurance company. Wharton lived in Tarboro, North Carolina, a medium-sized town not far from Greenville, and he had been trying to secure a federally backed home loan on a house being built by a local contractor who claimed to have access to FHA financing. The company's representatives had been stringing him along for weeks, offering vague assurances that never materialized into anything on paper. Eventually, Wharton gave up on them and turned instead to a man he believed might actually help, Asa T. Spaulding, a vice president of the North Carolina Mutual Life Insurance Company, headquartered in Durham, and one of the most prominent black business figures in the country. Wharton's letter to Spaulding was partly congratulatory and partly a plea. He needed a mortgage. He believed North Carolina Mutual might be the only institution that would actually provide one. His instinct was correct, and his situation was not unusual. For decades in the first half of the 20th century, one of the few reliable paths to a home mortgage for a black family in America ran not through a bank, but through a life insurance company, specifically a black-owned one. The logic behind this was financial as much as social. Life insurance companies collected premiums from policyholders and needed somewhere to invest the accumulated capital in a way that would generate steady, reliable returns. Mortgages, which produced regular interest payments over long periods and were secured against real property, fit that requirement well. Black-owned insurance companies, looking at a market of black homebuyers that white lenders refused to serve, saw both a financial opportunity and a community obligation, and they moved into the gap. The president of the Chicago-based Supreme Liberty Life Insurance Company, Harry H. Pace, stated the underlying reality with considerable directness in 1934. He said that one thing had stood out in the insurance business as conducted by black people from the very beginning, and that was that these companies had been organized largely to furnish a place where their customers could go to get mortgage money. He was describing not a side function of the insurance business, but what many in it understood as a central purpose. North Carolina Mutual, founded in Durham in 1898 by John Merrick, Aaron McDuffie Moore, and Charles Clinton Spaulding, became the largest black-owned life insurance company in the country, and its reach into the mortgage market was substantial. Historical records indicate that 3 out of every 4 federally underwritten mortgages held by black banks in its region were associated with North Carolina Mutual's network. The company's president at the time, C.C. Spaulding, described the institution's approach to homeownership in terms that made the mission explicit. The company had built several hundred homes on what he called the easy payment plan, because homeownership, in his view, made better citizens. Atlanta Life Insurance Company, founded in Atlanta in 1905 by Alonzo Herndon, a man who had been born into slavery and became one of the wealthiest black Americans of his era, pursued a similar strategy in the Southeast. By 1952, the number of black legal reserve insurance companies across the country had grown to 29, twice as many as had existed at the start of the Depression in 1930, and their combined assets had grown from $22 million at the start of the Second World War to $161 million by that same year, a growth of more than 600%. North Carolina Mutual and Atlanta Life led the field. These companies operated under constraints that their white counterparts did not face. Their policyholders had, on average, less accumulated wealth. The neighborhoods where their mortgage customers lived had been systematically devalued by federal appraisal practices, which complicated the collateral calculations that any lender had to make. And the FHA and VA loan programs that were reshaping the white mortgage market in the post-war years remained largely inaccessible to black buyers, meaning that black-owned insurance companies were often working with conventional loans in a market that had been restructured around government-backed instruments. Despite all of this, they lent. They assessed properties personally, sent their own committee members to evaluate homes their competitors refused to appraise, and built portfolios of mortgages in communities the mainstream market had written off. The families who received those mortgages got something beyond financing. They got acknowledgement from an institution that shared their history and understood their circumstances, that their desire to own a home was legitimate, and their ability to repay was real. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. Black life insurance companies turned premium payments into mortgage money and opened doors that no bank would touch. The next story follows a different current of community finance, into the credit unions that black communities began building in the 1920s. Member-owned institutions that brought character-based lending to families the mainstream market had never bothered to know. Section 9. Black Credit Unions and the Power of Knowing the Borrower. In Richmond, Virginia, in 1936, 10 black school teachers walked into a meeting and came out having built something. The Great Depression was not yet over. Mainstream banks were still largely closed to black depositors and borrowers, and the teachers, like most black professionals of their era, had nowhere to put their money that felt both safe and aligned with their community's interests. So they pooled what they had, drew up the paperwork for a credit union, and opened their doors to members. The institution they created eventually became known as the Richmond Heritage Federal Credit Union, and it operated as the last black-owned financial institution in the city, well into the modern era. The teachers who founded it understood something that would later be articulated by historians and economists, but that they grasped from direct experience: that ownership is power, and that a financial institution owned by the community it serves makes decisions that a bank owned by outside shareholders never will. Credit unions as a concept were not new by the time black communities began building them in significant numbers. The model had arrived in American shores in 1909, borrowed from cooperative finance traditions in Europe, and the first black-serving credit unions appeared around 1920. Growing out of the same soil that had produced mutual aid societies and fraternal orders. What distinguished the credit union from those earlier structures was its formal legal status, its regulatory framework, and its capacity to operate at a scale and with a permanence that informal savings circles could not always sustain. The credit union ran on a principle that made it structurally different from a commercial bank in ways that mattered deeply to black borrowers. A commercial bank's primary obligation was to its shareholders, and those shareholders had no particular reason to care whether the bank served black communities well or served them at all. A credit union's obligation was to its members, who were also its owners. Every depositor held a stake in the institution and a voice in how it was run. Surpluses were returned to members rather than distributed to outside investors. Loan decisions were made by people who often knew the borrowers personally, lived in the same neighborhoods, worshipped in the same churches, and had a direct interest in the financial health of the community the institution served. That last point produced a form of lending that historians of black finance have described as character-based, meaning that the assessment of a loan applicant went beyond the numbers on a page to include the lender's personal knowledge of the borrower's history, habits, and reliability. In communities where black families had little access to the formal credit histories that mainstream lenders required, and where those histories, when they did exist, were frequently distorted by discriminatory practices that made black borrowers look riskier than they actually were, this personal knowledge was not a soft substitute for rigorous lending. It was a more accurate form of risk assessment, because it drew on information the numbers did not contain. For homeownership specifically, the credit union served several functions. small loans for closing costs, which could prevent a transaction from falling apart at the last moment, were more accessible through a credit union than through any other formal institution. Savings accounts that paid fair returns and were held in a member-owned institution gave families a secure place to accumulate the down payments they needed. And for members who had already purchased homes, credit union loans for repairs and improvements helped protect an asset that the mainstream market had been designed to devalue. The civil rights era brought a significant expansion of black credit unions. Under the Great Society programs of the Johnson administration in the 1960s, hundreds of new credit unions were chartered in low-income communities, many of them in black neighborhoods, providing access to small-dollar loans and savings accounts for families that predatory lenders had been circling for decades. Civil rights leaders recognized the credit union model as a natural extension of the movement's economic goals, a vehicle for building financial power within communities rather than simply seeking access to institutions that had historically excluded them. The partnership between credit unions and the physical infrastructure of black community life was deliberate and important. Black credit unions built their membership through churches, schools, and civic organizations, using the trust networks that already existed rather than trying to construct new ones from scratch. The church vouched for the credit union. The credit union served the church's members. The relationship reinforced itself, and the institution grew in proportion to the strength of the community that anchored it. What the black credit union offered, stripped of institutional language, was a place that treated a black family's financial life as worthy of the same careful, respectful attention that any other families deserved. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. Credit unions gave black communities a member-owned institution that knew its borrowers by name and by character, not just by credit score. The next story turns to a path that was far more treacherous: the land contract, which offered black families a way into homeownership that looked like a mortgage, but functioned, in too many cases, like a trap. Section 10. The land contract, the door that led somewhere dangerous. On the west side of Chicago in the 1950s, a black family might spend years saving every dollar they could spare, scrimping through winters and skipping pleasures they could barely afford anyway, until they had accumulated enough for a down payment on a home. Then they would go looking for a house, and they would find, as virtually every black family in that city found during those decades, that the banks would not give them a mortgage. The neighborhoods they could afford to live in had been redlined. The neighborhoods they might aspire to live in had restrictive covenants, or hostile neighbors, or both. The options available to them were narrow, and into that narrowness stepped a particular kind of seller, with a particular kind of offer. The offer was called a contract for deed, or a land contract, or a home installment contract, depending on where you were and who was talking. In plain terms, it worked like this. A seller, often a speculator who had recently purchased the property from a white family fleeing a racially changing neighborhood, would agree to sell the house to a black buyer without going through a bank. The buyer would make a down payment, then make monthly payments directly to the seller. The seller would retain the legal title to the property until the very last payment was made. In the meantime, the buyer lived in the house, maintained it, paid property taxes on it, and bore responsibility for every repair it needed. But the buyer did not own it. The deed would change hands only at the end, when the final payment cleared. On paper, this arrangement gave black families access to homeownership when banks refused them. In practice, for many families, it delivered something closer to a sophisticated mechanism for extracting everything they had. The terms were rarely fair. Historians studying Chicago's contract buying market have found that sellers typically marked up the purchase prices by enormous amounts, sometimes as much as 75% above what they had paid for the property themselves, often within a matter of weeks. Interest rates were higher than conventional mortgages. The monthly payments frequently exceeded what the same house would have rented for, meaning buyers were paying more than renters for a property they did not yet own, and might never own. And woven through every contract was a clause that made the whole arrangement catastrophically risky. If the buyer missed a single payment, the seller could cancel the contract immediately, evict the family, keep every dollar they had paid to that point, and resell the property to the next desperate family in line. There was no equity accumulation until the very end. A family that had faithfully paid on a contract for 10 years, meeting every obligation, had built exactly zero legal equity in the property. They could be removed for missing a payment the same day as a family that had signed the week before. The law in most states provided almost no protection for contract buyers, and sellers understood this and used it. Historian Beryl Satter, whose father was a lawyer who represented exploited contract buyers in Chicago, estimated that approximately 85% of properties bought by black buyers in Chicago in the 1950s were purchased through these contracts. The scale of wealth transfer that this represented is difficult to calculate with precision, but it was enormous. Black families poured their savings, their labor, and their monthly earnings into properties they were not legally permitted to own until the final payment, and sellers collected that stream of income while retaining the asset against which it was secured. In 1968, black families in Chicago who had been buying on contract organized themselves into the Contract Buyers League, led by people including Clyde Ross and Ruth Wells. Their goal was to challenge the system that had exploited them and to renegotiate the terms of the contracts they were locked into. They went on rent strikes, withheld payments to force sellers to the table, and filed lawsuits that drew attention to the federal government's role in creating the conditions that made contract buying the only option available. The effort achieved mixed results in legal terms, but it documented the scale of what had happened in a way that could not be ignored. The land contract was not, in itself, a black invention or a black choice. It was a product of exclusion, something that existed because every other path had been closed. Some families did manage to reach the end of their contracts and receive the deeds they had been promised, and for them, the arrangement delivered, eventually, what it had offered. But the number who lost everything to a missed payment, a predatory clause, or a seller who found a technical reason to cancel and start the cycle again, was enormous. The land contract was the door that opened when all the others were shut, and too often, it led somewhere very dark. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. The land contract showed what happened when the only path available was one designed by someone who profited from the traveler's desperation. The next story moves to a very different kind of institution, the Fraternal Lodge, where black men pooled resources, built credit, and quietly opened doors to homeownership through networks of brotherhood that the wider world barely noticed. Section 11. The Fraternal Lodge as a financial network. Auburn Avenue in Atlanta was known, at the height of its prosperity in the early 20th century, as the richest Negro street in the world. Along its length stood insurance offices, banks, law firms, barbershops, and churches, the full infrastructure of a community that had built its economic life largely from the inside. And anchored among those institutions, occupying a prominent corner of the street's civic landscape, was the Prince Hall Masonic Temple. The building that eventually rose there in 1940, after years of planning and collective effort, was more than a meeting place. It was a physical demonstration of what organized, disciplined, long-term pooling of community resources could produce. Within its walls operated, among other things, the offices of the Southern Christian Leadership Conference. Downstairs, members continued to do what fraternal lodges had always done: collect dues, maintain records, support one another through hardship, and build the kind of trust that had financial consequences long after the meeting adjourned. The Fraternal Order was one of the oldest and most widespread institutions in Black American life. The Prince Hall Masons, founded in 1784, when Prince Hall and 14 other free black men sought membership in a Boston lodge and were refused, received their charter from the Grand Lodge of England, and built from that beginning an organization that by the early 20th century counted more than 66,000 master masons, with another 50,000 apprentices, spread across lodges in nearly every black community in the country. The Grand United Order of Oddfellows reached a membership of around 300,000 at its peak. The Knights of Pythias, the improved Benevolent and Protective Order of Elks, the Order of the Eastern Star, and a range of other fraternal bodies each operated their own networks, all of them structured around the same basic principles of mutual obligation, collective resource pooling, and the cultivation of trust among members. What made these organizations financially significant was not any single dramatic act of lending or investment, but the steady, quiet accumulation of capital and relationship that their structure produced over time. Members paid dues regularly, creating a pooled fund that the organization managed on behalf of its members. That fund covered sick benefits, funeral expenses, and support for widows and orphans, the classic mutual aid functions that these orders had performed since their founding. But the financial relationships that formed within lodges extended beyond the formal mechanisms of the organization itself. Members who knew each other through years of shared ritual, shared obligation, and shared community service developed the kind of personal trust that translated directly into informal financial cooperation. A man who needed capital to make a down payment, or to bridge a gap between what he had saved and what a seller required, was far more likely to find a willing lender within his lodge than through any formal institution. The lender knew him. They had sat in the same meetings, performed the same rituals, vouched for one another in ways that carried real social weight. The loan that resulted from that relationship was not documented in any bank ledger, but it was real, and it moved real families into real homes. The Prince Hall Masons formalized some of this activity over time. In 1952, the fraternity launched the Prince Hall Credit Union specifically to provide loans to members at a time when discrimination in housing and banking remained pervasive and largely legal. In California, the fraternity developed apartment complexes in San Diego and partnered with other nonprofits in Los Angeles to sponsor housing developments using federal financing, demonstrating that the organizational capacity built through decades of lodge governance could be turned toward brick-and-mortar homeownership programs when the moment was right. In Oklahoma, where black settlers had followed the land rushes of the late 19th century in hopes of building something new, the Prince Hall Masons constructed a Masonic temple in the all-black town of Boley that was reported to be the tallest building between Oklahoma City and Okmulgee. The symbolism was not accidental. In a state where black communities were being squeezed by hostile legislation and the constant threat of violence, an imposing stone structure owned outright by a black fraternal organization sent a message about permanence and collective capacity that no individual family could have sent alone. The fraternal network also provided something that formal financial institutions could not replicate, which was portable credibility. A black man who moved from one city to another during the Great Migration could walk into a Prince Hall Lodge in his new city and be recognized as a member in good standing. That recognition connected him immediately to a network of people who had reason to trust him, which in a new city where he knew no one and no institution knew him was not a small thing. It was, in practical terms, a letter of introduction that opened doors, including the doors of landlords and sellers who might otherwise have had no basis for extending credit or confidence. The fraternal order did not replace the bank or the credit union. It operated alongside them, and often fed into them, providing the social infrastructure of trust on which all the other financial mechanisms depended. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. The fraternal lodge built trust across generations and turned brotherhood into purchasing power for families who had no other network to call on. The next story follows millions of black families as they moved north and west during the Great Migration and traces the community networks they built in unfamiliar cities that quietly became the scaffolding of black homeownership in a new landscape. Section 12. The Great Migration and the networks that moved with it. Between 1910 and 1970, approximately 6 million black Americans left the South. They left in waves, on trains and buses, and in cars packed with everything a family could carry, moving toward Chicago and Detroit and Cleveland and Los Angeles and New York, and a dozen other cities where the factories were hiring, and the laws, at least on paper, did not include the particular brutal architecture of Jim Crow. The movement was the largest internal migration in American history, and it remade the demographic map of the country in a generation. What is less often told is how thoroughly it also remade the financial landscape of Black community life, and how the networks that formed along the migration routes became, for many families, the primary mechanism by which they eventually reached home ownership. The decision to migrate was rarely made in isolation. It was made because a cousin had already gone and sent back a letter describing what work was available and what a room cost, and which neighborhoods were possible. It was made because a deacon in the church had a contact in Pittsburgh who knew a foreman at the steel mill. It was made because the Chicago Defender, the most widely read Black newspaper in the country, had been smuggled south on Pullman trains by porters, who distributed it through barbershops and churches, and its pages described a world where Black men were paid wages, and Black families lived in houses they sometimes owned. The migration was organized through informal networks of information and relationship, long before anyone arrived at a new city's train station. Those networks did not dissolve once families settled, they thickened. Churches that had existed in the South extended themselves northward, establishing sister congregations in the cities where their former members had landed, and those churches became anchoring institutions for newly arrived families in exactly the same way they had functioned back home. A family that arrived in Chicago from Mississippi in 1922, with no connections and limited savings, could walk into a Black church on the South Side and find, within weeks, a community that would help them navigate the city, identify trustworthy landlords, avoid the worst of the predatory housing arrangements that awaited the unwary, and eventually point them toward the institutions, thrifts, fraternal orders, and informal lending networks where a family serious about buying a home could begin to make progress. The Black neighborhoods that formed in northern cities during the migration years were not the product of free choice. They were the product of restriction, the combined effect of restrictive covenants, hostile reception in white neighborhoods, and the simple reality that Black families needed to live near the churches, businesses, and social networks that made their lives in a new city manageable. But within those restrictions, the communities that formed were dense, with the kind of social capital that financial historians have increasingly recognized as a genuine economic asset. People who knew each other, owed each other favors, worshiped together, sent their children to the same schools, and shared the same barbershop were people who had the foundation for the kind of informal financial cooperation that moved real money between real families. The Pullman porters deserve particular mention in this story. The Brotherhood of Sleeping Car Porters, the union organized by A. Philip Randolph and officially recognized in 1937 after a decade of struggle, represented workers who occupied a uniquely positioned role in Black economic life. Porters traveled constantly between cities, which made them couriers of information, newspapers, and opportunity. Many of them earned wages that, while modest by white professional standards, were reliable and regular enough to support the kind of disciplined saving that homeownership required. Porter families became anchors of Black middle-class homeownership in cities across the country, and the networks that Porter communities maintained across the rail system connected Black communities from one end of the country to the other in ways that had direct financial consequences. Real estate agents within Black communities played a role that is sometimes overlooked. Black realtors, operating within the segregated neighborhoods where their clients could actually buy, developed deep knowledge of which properties were available, which sellers might be willing to negotiate terms, and how to structure transactions that worked around the barriers mainstream finance erected. They were not always able to deliver fair prices, because the market they operated in was itself distorted by the restrictions that had created it. But they provided navigational knowledge that newly arrived families could not have acquired on their own, and that knowledge had real value in a housing market designed to confuse and exploit the uninformed. What the Great Migration produced, in financial terms, was a concentration of Black community resources in northern and western cities dense enough to support the formal institutions, the banks, the credit unions, the thrifts, that Black communities had been building in smaller numbers across the South. It created the critical mass that made those institutions viable. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. The Great Migration built communities dense enough to sustain their own financial institutions, and it carried the networks of trust that made informal lending possible in unfamiliar cities. The next story looks at the voices that guided those communities through the confusion of a new landscape. The black newspapers that told families not just what was happening in the world, but how to navigate the housing market that was trying to work against them. Section 13. The Black Press and the Housing Education Nobody Else Provided. Robert S. Abbott founded the Chicago Defender in 1905 with almost nothing. He printed the first issues himself, sold them for a nickel apiece, and built distribution through a network of Pullman porters who carried bundles of the paper south on the trains and dropped them at pickup points in cities and towns where the paper was sometimes banned outright and possession of it could attract hostile attention. By 1920, Abbott employed hundreds of people, and the Defender had become, by wide consensus, the most important black newspaper in the country, with a circulation and an influence that reached far beyond Chicago. What Abbott understood, and what the editors of the Pittsburgh Courier, the Baltimore Afro-American, the New York Amsterdam News, and dozens of other black papers understood alongside him, was that information was a form of power, and that black families had been systematically denied access to the information they needed to make sound decisions about housing, finance, and economic life. The black press filled that gap in ways that went well beyond reporting. Housing columns appeared regularly, explaining in plain language what a deed was, and how title worked, and what a buyer should look for in a contract before signing. Financial advice columns addressed the specific circumstances of black readers, acknowledging the barriers they faced and offering practical strategies for navigating around them, rather than pretending those barriers did not exist. Listings of black real estate agents, black-owned banks, and black fraternal organizations with housing programs gave readers a directory of the parallel economy they could actually access. And editorials, sustained over years and decades, made the case for homeownership as a form of community power and personal independence in terms that made the political dimension of the act visible to ordinary readers. The Pittsburgh Courier, at its peak in the 1930s and 1940s, published in 14 cities and reached a weekly circulation of 500,000 readers. Its coverage of housing discrimination was pointed and sustained, documenting specific cases, naming specific institutions, and connecting individual experiences of rejection to the larger system of policy that produced them. When the Courier advocated for improved housing conditions and better access to mortgage financing, it was not making abstract arguments about fairness. It was giving its readers a framework for understanding their own situation and a language for demanding something better. The Defender's role in the Great Migration was particularly direct. Abbott published job listings, train schedules, and descriptions of conditions in northern cities, effectively functioning as a migration guide for families weighing whether to leave the South. But his paper also told those families what to expect in the housing market once they arrived, which neighborhoods were possible, what prices looked like, and what pitfalls awaited the unwary buyer. That practical guidance, delivered through a publication that black communities trusted in a way they had learned not to trust mainstream newspapers, was a form of financial education that no bank and no government agency was providing. The black press also served as a watchdog on the institutions that were supposed to serve black communities. When a black-owned bank showed signs of mismanagement, black newspapers reported it. When a neighborhood building and loan association was performing well and helping families into homes, black newspapers celebrated it and sent readers its way. The informal accountability that this created was not perfect, but it was real, and it operated in a community where the mainstream financial press had no interest in providing any accountability at all. There was a literacy dimension to this that matters. The households that read the Defender or the Courier regularly were households that were engaged, informed, and oriented toward economic participation in ways that had direct consequences for their financial behavior. A family that understood what a restrictive covenant was and how it worked was a family that could make more informed decisions about where to buy and on what terms. A family that knew which local institutions were trustworthy was a family that could direct their savings and their mortgage application toward something that might actually succeed. The black press did not give families money. It gave them something that, in a housing market designed to confuse and exploit them, was almost as valuable. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. The black press turned information into a community resource, arming families with the knowledge they needed to navigate a hostile housing market. The next story moves from words on a page to acres of land, into the cooperative land purchases that black communities organized after emancipation, and which established a tradition of collective land ownership that would echo forward into the community land trust movement a century later. Section 14. Cooperative land purchase and the first land trusts. After the Civil War ended and the promise of 40 acres was broken, black communities in the South faced a stark and clarifying situation. The federal government had demonstrated that it would not redistribute land to the people who had worked it without compensation for generations. The former slaveholders who held that land had demonstrated that they would not sell it on fair terms if they could avoid it. And the sharecropping system that emerged in the place of both promises had demonstrated, with considerable efficiency, that it was designed to keep black families in perpetual debt rather than allow them to accumulate anything. Against all of that, black communities began doing what they had always done when the formal systems failed them. They organized among themselves and bought land together. The earliest examples of cooperative black land purchase after emancipation were both remarkable and fragile. In Davis Bend, Mississippi, a community of formerly enslaved people led by Benjamin Montgomery purchased approximately 4,000 acres of land from Joseph Davis, who was the brother of the former Confederate President Jefferson Davis. Montgomery had been enslaved by the Davis family, had taught himself to read and write, and had managed the plantation store with enough skill that his former enslaver agreed to sell him the land on an installment basis. The community he built on that land operated as a cooperative, with families working individual plots and sharing in collective decisions about the whole. It was not permanent. Crop failures and the hostile legal environment of the post-Reconstruction South eventually broke it apart. But it existed, and its existence proved that collective black land ownership was not a fantasy. Across the South in the decades after emancipation, similar efforts appeared in different forms. Groups of freed people pooled money to purchase tracts of land that no individual among them could have bought alone. Churches organized land purchase funds. Fraternal orders coordinated the acquisition of property that would anchor their communities. The price of land in the immediate post-war period was, in many parts of the South, low enough that disciplined collective saving over a period of months could produce the sum needed, and some communities moved quickly enough to take advantage of that window before the political and economic climate closed it. The tradition that these efforts established carried forward into the 20th century in forms that were both more organized and more explicitly political. In 1969, a group of civil rights organizers in southwest Georgia, including Charles Sherrod, Shirley Sherrod, and Slater King, established New Communities Incorporated, a nonprofit that purchased approximately 5,000 acres of farmland and forest near Albany, Georgia. The purchase made it, at the time, the largest tract of land owned by black Americans in the United States. The model they used, in which the organization held the land in perpetual trust, while individual families occupied homes and farmed plots on it, was a direct ancestor of what would become the modern community land trust movement. The idea behind the community land trust was simple and powerful. By separating the ownership of the land from the ownership of the structures built on it, the trust could ensure that homes remained affordable across generations. A family that bought a home on trust land agreed to sell it back at a price formula that preserved affordability for the next buyer, in exchange for a lower purchase price and security of tenure that conventional homeownership in a volatile market did not always provide. The land itself, held by the community organization in perpetuity, could never be sold to a developer or lost to speculation. What the community had built remained the community's. New Communities Incorporated eventually lost its land in the early 1980s, after a prolonged drought and the denial of federal loans by the Department of Agriculture, a denial that decades later was found to reflect racial discrimination and resulted in a substantial legal settlement for the surviving members of the organization. The loss was devastating, but the model survived its first defeat and spread. By the 2010s, more than 300 community land trusts were operating across the United States, many of them in communities of color, carrying forward the principle that had been present in Benjamin Montgomery's cooperative farm and in the Albany, Georgia land purchase, that collective ownership of land, held in trust for the community rather than surrendered to the market, was a foundation that individual homeownership alone could not provide. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. Cooperative land purchase established a tradition of collective ownership that has never entirely disappeared, building the foundation beneath individual homes that the market alone would not hold steady. The next story moves from the rural South to the oil-rich plains of Oklahoma, where one black community built an economy so self-sufficient that it created its own internal credit system, and where the story of what was built and what was destroyed remains one of the most powerful in American history. Section 15. Black Wall Street and the internal economy of Greenwood segregation was intended as a ceiling. In Tulsa, Oklahoma, in the first 2 decades of the 20th century, it functioned instead as a greenhouse. The laws and customs that kept black residents confined to a specific district on the north side of the city denied them access to white-owned businesses and blocked them from the mainstream financial and commercial markets, produced, as an unintended consequence, an economy so thoroughly self-contained that the money circulating within it had almost nowhere else to go. Every dollar spent with a black doctor went to a black doctor who spent it with a black grocer, who spent it with a black landlord, who paid a black contractor to fix his roof. Researchers studying the district have cited accounts suggesting that a single dollar might circulate within the Greenwood community for many months before finding its way out. Whether that precise figure is exactly right, or somewhat embellished in the retelling, the underlying dynamic it describes was real, and its effects were visible. O.W. Gurley arrived in Tulsa in 1905 with land he had purchased and a deliberate vision. He divided his property into residential and commercial lots and sold them specifically to black buyers, understanding that the concentration of black-owned property in a single district would create the density of economic activity that made a self-sustaining community possible. He opened businesses, loaned money to others who wanted to do the same, and by 1921 owned more than 100 properties in Greenwood with a personal net worth that sources estimate at between $500,000 and $1 million in the values of the time. J.B. Stratford, who had a law degree from Indiana University, purchased vacant lots and sold them to black residents for development, then built the largest black-owned hotel in the country, a 54-room establishment with a pool hall, saloon, and grand dining room. By 1921, the Greenwood District, which covered roughly 35 square blocks, contained 191 businesses, 2 schools, a library, a hospital, and a public transit system, all of it owned and operated within the black community. The internal credit system that made this possible was not formalized in the way a bank formalizes credit, but it operated on the same fundamental principle. Business owners extended credit to customers they knew. Landlords who owned multiple properties used the rental income from one to finance improvements on another. Entrepreneurs who had established themselves helped newer arrivals get started, not always through formal loans but through the extension of goods, services, and time that functioned as credit within a community of mutual recognition. The knowledge that everyone in Greenwood depended on the same ecosystem created an incentive for cooperation that the wider market, which excluded black participants entirely, could not generate. Gurley himself was known for lending money to residents and entrepreneurs who wanted to build or buy within the district. He was not operating as a licensed lender, and his terms were not recorded in any regulatory filing. He was operating as a community member with resources, extending those resources to other community members on the basis of personal knowledge and shared interest. That form of lending, informal but consequential, was present throughout Greenwood and throughout Black Wall Street communities across the country that never achieved Greenwood's scale, but operated on the same principles. On May 31st and June 1st of 1921, a white mob, sanctioned and in some accounts armed by city officials, swept through Greenwood. Between 75 and 300 black residents were killed, with estimates varying across historical accounts, and the true number remaining a matter of ongoing research. 35 square blocks were burned. More than 1,000 homes were destroyed. Approximately 10,000 people were left without shelter. The insurance claims that survivors filed were almost universally denied, with insurers citing riot exclusion clauses. The wealth that had been built over 15 years of disciplined community effort was erased in less than 24 hours. What happened next is the part of the story that is most often omitted. The survivors rebuilt. Within a year, 80 businesses had reopened. By 1942, the district contained 242 black-owned and black-operated establishments, more than had existed before the massacre. The rebuilding happened without government assistance, without insurance payments, against the active opposition of white Tulsa political leaders who attempted to use rezoning laws to prevent reconstruction, and in the face of a city that had just demonstrated what it was willing to do to black prosperity when it grew visible enough to attract envy. The community rebuilt anyway, drawing on the same internal networks, the same collective discipline, and the same principle that had built the district in the first place, that what the community built together, the community could rebuild together. Greenwood was eventually diminished not by another act of violence but by a combination of urban renewal, highway construction, and the economic disruption of desegregation, which opened the wider market to black consumers and drew dollars out of the internal economy that had sustained the district. The highway that cut through North Tulsa in later decades completed what the massacre had begun. But for the period of its greatest flourishing, Greenwood demonstrated something that planners and economists have spent decades trying to recreate in other contexts: that a community which controls its own economic circulation can build genuine wealth even under conditions of systematic external exclusion. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. Greenwood built an internal economy so powerful that segregation became its engine rather than its ceiling, until violence took in a single day what years of collective effort had built. The next story leaves the city behind and moves into the fields, following the slow, grinding discipline of black sharecroppers, who found, over years and decades, a path from the crop rows to a deed of their own. Section 16. Sharecroppers, savings, and the long road to a deed. The mathematics of sharecropping were designed to prevent accumulation. A sharecropper family farmed a plot of land belonging to a white landowner, received a share of the crop at harvest, and owed against that share the cost of the seeds, the tools, the food, and the credit advance to keep the family alive through the growing season. The accounting was done by the landowner, recorded in ledgers the sharecropper often could not read, and settled at year's end, in a calculation that, with remarkable consistency, left the family in debt rather than in profit. A sharecropper who ended the year owing more than the crop had produced owed that debt into the next year, and the year after that, and the system was structured so that the debt rarely cleared, and the family rarely left, and yet some did. Some families found, through a combination of extraordinary discipline, favorable seasons, secondary income, and the kind of careful navigation of a hostile system that required both intelligence and patience, a way to accumulate enough to buy land. The path was long, and the obstacles were genuine, but it was traveled, and understanding how it was traveled reveals something important about the financial strategies available to black families at the very bottom of the economic structure. The first requirement was secondary income. A sharecropper family that relied entirely on the crop share was almost certainly going to end every year in the red, because the system was calibrated to produce that outcome. Families who found ways to earn money outside the crop share relationship had a different equation to work with. Women took in laundry and ironing from white households, charging per piece, and collecting in cash that did not pass through the landowner's ledger. Men hired themselves out for additional agricultural labor, carpentry, or hauling, during seasons when the main crop did not require their full attention. Children picked berries, trapped small animals, and sold what they could. Every dollar that came in through these channels, and did not flow back out through the landowner's credit system, was a dollar available for a different purpose. The second requirement was concealment. A sharecropper family that was visibly accumulating savings attracted attention from a system that was built to prevent exactly that. White landowners who noticed a tenant family getting ahead had multiple tools available to reverse the situation, from manufactured debt to legal harassment to the threat of violence, and those tools were used. Families who managed to save did so quietly, keeping money hidden in ways that left no visible trace, and moving toward land purchase only when they had accumulated enough to act quickly and present the transaction as a fait accompli, rather than a plan that could be interrupted. The third requirement was community. Individual families rarely accumulated enough to purchase land entirely on their own. What made land purchase possible for sharecropper families was the same mechanism that made it possible for families in northern cities: pooling. Groups of families, sometimes connected through kinship and sometimes through church membership or simple proximity, combined their separate savings toward a shared purchase, then divided the land among themselves. The cooperative land purchases that historians have documented in various parts of the rural South after emancipation were not always the organized affairs of formal organizations. Many of them were quiet arrangements between 3 or 4 families who trusted each other and had enough combined savings to act. Land prices in parts of the South in the decades immediately after emancipation were low enough that this strategy was actually viable, particularly on land that white owners considered marginal or difficult to farm. By the early 20th century, the window was narrowing as land values rose and as white resistance to black land ownership intensified. Between 1910 and 1997, black land ownership in the South declined from approximately 15 million acres to less than 2 million, a loss driven by a combination of legal manipulation, tax sales, partition actions in the courts, and outright violence. The gains made through sharecropper saving and cooperative purchase were not secure against a system that had multiple mechanisms for reclaiming what black families had managed to acquire. But the effort itself, the decades of concealed saving, secondary labor, and collective pooling that carried some families from the crop rows to a deed, represents one of the most demanding and least celebrated forms of black financial strategy in American history. The people who traveled that road did so with no assistance from any institution and against the active hostility of the system they were trying to escape. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. Sharecroppers who reached a deed did so through years of hidden saving, secondary income, and collective effort against a system calibrated to prevent exactly that outcome. The next story turns to the women who built their own path to homeownership through decades of domestic labor in other people's houses, saving quietly toward the day they would own a house of their own. Section 17. Domestic workers and the discipline of the long save. 90% of black working women in the late 19th century were employed in domestic service. That figure, documented by historians of the period, captures something about the narrow range of economic options available to black women in an era when industrial employment was largely closed to them, professional careers were accessible only to a very small number, and the labor market had been structured, through custom and law, to funnel black female labor into the kitchens and laundry rooms and nurseries of white households. Domestic work was exhausting, poorly paid, often humiliating, and entirely without the legal protections that would eventually be extended to other categories of workers. It was also, for the women who did it with a specific long-term purpose in mind, a source of income that some families used, over years and decades of disciplined saving, to buy homes. The wages were small. A domestic worker in the early 20th century might earn between $2 and $5 a week for live-in work, with room and board provided but little else. Day workers who traveled to and from white households rather than living in them earned somewhat more in cash, but bore their own living expenses. Neither arrangement produced an income that would strike any outside observer as a foundation for homeownership. What it produced, for women who approached it with deliberate financial intention and an almost punishing willingness to defer every other expenditure, was a slow accumulation of cash that did not pass through any institution that could discriminate against it, because it was held in the hand and under the mattress, and in the careful keeping of a woman who trusted her own discipline more than she trusted any bank. The live-in arrangement had a particular financial logic for women focused on saving. Room and board covered by the employer meant that virtually all of a domestic worker's wages could be saved rather than spent on her own maintenance. A woman who lived in her employer's house, ate food provided by her employer's kitchen, and wore uniforms provided by her employer's household had almost no necessary expenses. Every dollar she earned was potentially a dollar saved. The conditions that made live-in domestic work so exploitative in most respects, the constant availability it demanded, the blurring of work and personal time, the isolation from one's own community, the subordination of one's own domestic life to someone else's, also meant that there was very little opportunity to spend money, which for a woman saving toward a specific goal was a form of enforced discipline that produced results over time. The amounts that domestic workers saved are not recorded in any comprehensive historical archive, because the saving happened informally, and the decisions that resulted from it were made within families rather than through institutions. What survives is a pattern visible in community records, family histories, and oral accounts. The domestic worker who saved for 20 years and bought a house in a black neighborhood where her daughter and grandchildren continued to live. The woman who worked for a white family for decades was underpaid by any fair measure and used what she earned to build the one thing that gave her family a foundation after she was gone. Some women combined domestic work with susu participation, contributing a fixed amount each pay period to a circle of co-workers or church members, and receiving their turn as a lump sum that served as a down payment or a payment to clear a contract for deed. The social networks that domestic workers maintained, often through the churches they attended on their days off, and the fraternal organizations their families belonged to, connected them to the informal financial systems that made those cooperative saving arrangements possible. The National Domestic Workers Union and similar organizations that began organizing domestic workers in the mid-20th century understood that wages and working conditions were inseparable from questions of housing and wealth. A domestic worker who earned a fair wage and worked defined hours was a domestic worker who could save more and save faster. The labor organizing that these women pursued was, among other things, a housing strategy, because every dollar gained through better wages was a dollar available toward the down payment that sat at the end of the long save. The homes that domestic workers bought, modest by most standards, but owned outright and free of the predatory terms that characterized so many black housing transactions of the era, were often the first property their families had ever held. They became the foundation on which the next generation built, the asset that could be borrowed against or passed down, the physical anchor of a family's economic life that nothing else in the domestic workers' world had been able to provide. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. Domestic workers saved in the margins of other people's abundance, turning decades of underpaid labor into deeds that anchored their families for generations. The next story moves from individual discipline to collective design, into the community land trust movement that black civil rights organizers built in the late 1960s as a permanent answer to the impermanence that had always threatened black land ownership. Section 18. Community Land Trusts and the Permanence of Collective Ownership. In 1961, the city of Albany, Georgia, became the site of the Albany Movement, one of the first mass campaigns of the modern civil rights era to seek the complete desegregation of an entire Southern community. The all-white city council resisted, demonstrations were met with mass arrests, and the people who organized and participated in the protests paid a price that went beyond jail time. Black families who raised their voices found themselves evicted from homes they rented from white landlords. Black workers who marched lost jobs held at the sufferance of white employers. The connection between political participation and economic vulnerability was not abstract. It was immediate, personal, and devastating. A community organizer named Charles Sherrod watched this happen again and again, and understood something that would take him years to act on fully: that without control of the land beneath their feet, black families in the South could be silenced simply by threatening the roof over their heads. The idea that grew from that understanding took shape slowly over the following years, drawing on traditions of cooperative land ownership that reached back to the Freed People's Cooperatives of Reconstruction, and on newer thinking about land reform emerging from international development movements. What Sherrod and his colleagues, including Shirley Sherrod and Slater King, eventually built was New Communities Incorporated, established in 1969 in southwest Georgia. The organization purchased approximately 5,000 acres of farmland and forest north of Albany, making it at the time the largest tract of land owned by Black Americans in the United States. Families could live and farm on the land without owning it individually, protected from the eviction that had been used as a political weapon against them, because the land belonged to the community organization rather than to any individual or outside interest. The model they pioneered separated land ownership from home ownership in a way that addressed one of the most persistent vulnerabilities of black property holding in America. Individual black homeowners, no matter how carefully they had saved and no matter how legitimately they had acquired their properties, had always been exposed to a range of mechanisms by which that property could be taken from them. Tax sales that moved too quickly for families to respond. Partition actions in which courts forced the sale of land held by multiple heirs. Eminent domain proceedings that compensated black owners at fractions of market value. And, most directly, the simple economic pressure that came from owning property in neighborhoods that the market had been engineered to devalue. Community land trust ownership was designed to be resistant to all of these. Because the land was held by an organization rather than an individual, it could not be seized for a single family member's debt, could not be lost through one heir's financial difficulty, and could not be sold to a speculator without the organization's consent, which the organization's charter made extremely difficult to give. New Communities Incorporated eventually lost its land in the early 1980s, after a prolonged drought devastated the community's agricultural operations, and the United States Department of Agriculture denied or delayed loans that might have kept the organization solvent. Decades later, a federal investigation and legal settlement found that the USDA had discriminated against black farmers in its lending decisions during that period, and surviving members of New Communities received a portion of a large settlement. The loss was real and painful. But the model had already escaped its origins and begun spreading. The community land trust concept moved into urban housing in the 1970s and 1980s, finding new applications in cities where gentrification was beginning to displace the black families that decades of discriminatory policy had concentrated in specific neighborhoods. In Burlington, Vermont, a city with a very different demographic character from southwest Georgia, a community land trust established with the support of the city government became a national model for permanently affordable homeownership, demonstrating that the basic principle worked across very different contexts. By the 2010s, more than 300 community land trusts were operating across the country, a significant number of them in communities of color, and many of them explicitly rooted in the black civil rights tradition from which the model had sprung. What a community land trust offered a black family that conventional homeownership could not was security against the specific mechanisms that had historically undone black property holding. A family that bought a home on trust land bought it at a below-market price and agreed to sell it back at a price formula that preserved that affordability for the next buyer. In exchange, they received something that no market transaction could guarantee: the assurance that their community's land would remain in community hands, that the neighborhood they had built would not be dismantled by forces outside their control, and that the next generation would have access to the same affordable foundation they had been given. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. Community land trusts answered the question of permanence that individual homeownership could never fully resolve, building a foundation that the market could not dismantle and that speculation could not reach. The next story moves into the transactions themselves, into the world of seller financing within Black communities, where the person holding the deed sometimes became the lender for the person who needed it. Section 19. Seller financing within the community. Not every transaction that happened outside a bank involved a predatory speculator on one side and a desperate family on the other. In the same era when land contracts were being used by white speculators to strip wealth from Black buyers, a quieter and more equitable version of seller financing was operating within Black communities themselves, between Black sellers and Black buyers who shared a neighborhood, a church, a lodge, or simply a long enough history of mutual acquaintance to make a private transaction possible on terms that neither party would have found at any formal institution. The mechanics were similar to the land contract in their basic structure. A seller who owned a property outright, or who had paid enough of their own mortgage to hold substantial equity, would agree to sell to a buyer who could not obtain bank financing. The buyer would make a down payment and then make monthly payments directly to the seller, who would hold the deed until the balance was paid, or, in some arrangements, transfer the deed at the point of sale and take back a private mortgage secured against the property. The difference between this arrangement and the predatory version was not in the structure, but in the terms and the relationship. A Black seller financing a sale to a Black neighbor within a community where both parties had reputations to maintain and relationships to protect had very different incentives than a speculator who had bought a property specifically to resell it at an inflated price to someone with no alternatives. The prices in community seller financing arrangements tended to reflect something closer to actual market value for Black neighborhood properties, which were themselves undervalued by the discriminatory appraisal system, but were at least not marked up by an additional predatory premium on top of the systemic undervaluation. The interest rates were often lower than what a contract speculator would charge, sometimes dramatically so. The terms were negotiated face-to-face between people who knew each other, which meant they could be adjusted when circumstances changed in ways that a formal contract with a distant institution could never accommodate. A seller who knew that the buyer had lost a week of work to illness could agree to defer a payment without triggering the catastrophic default clause that ended so many land contracts in eviction. The Black professional class played a particular role in this kind of financing. Doctors, lawyers, teachers, and ministers who had managed to accumulate property over careers of disciplined saving sometimes became informal lenders within their communities, carrying notes on properties they had sold and collecting payments from buyers who would otherwise have had nowhere to turn. These arrangements were not always formally documented, and when they were documented, the paperwork was sometimes drawn up by the community's own lawyers rather than through any institutional process. They existed in the interstices of the formal economy, visible to the people involved and largely invisible to everyone else. The barbershop and the beauty parlor were particularly important nodes in the network where these transactions came together. These were the community gathering places where information about available properties circulated, where the question of who might be willing to carry a note on a sale was openly discussed, and where a buyer who needed financing and a seller who was open to providing it could find each other without any institutional intermediary. The barber who had been cutting the same customer's hair for 20 years knew who owned what, who was thinking of selling, who had saved enough for a down payment, and who was trustworthy enough to be trusted with a private mortgage. That knowledge was community infrastructure. There were risks in these arrangements, and honesty requires acknowledging them. Private seller financing within communities operated without the regulatory protections that formal mortgages eventually acquired, which meant that disputes between buyer and seller had to be resolved through personal negotiation or community pressure, rather than through an established legal framework. When the relationship between buyer and seller broke down, the resulting conflict could damage not just the two parties but the community networks that had brought them together, and the arrangements that were not formally documented created ambiguities that could become serious problems for heirs when the original parties died. Despite these vulnerabilities, the practice was widespread enough and successful enough to move significant numbers of black families into owned homes across the decades when formal financing was essentially unavailable. It operated on the same principle that animated every other mechanism in this story, that the community's own resources, directed by the community's own judgment about who was trustworthy and on what terms, could accomplish what the outside system refused to offer. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. Seller financing within black communities turned neighbors into lenders and personal trust into mortgage terms, filling the space that banks had vacated with something more human and more flexible. The next story returns to the church, but from a different angle, looking at the formal mortgage funds and congregation-backed lending programs that some churches developed into explicit financial institutions in their own right. Section 20. Fruch Mortgage Funds and Congregation-Backed Lending. The collection plate that circulated through a black congregation on a Sunday morning was not simply a gesture of faith, though it was certainly that. It was also the weekly mechanism of a community capital pool that, in the hands of churches that understood their financial power and chose to use it deliberately, could become something considerably more structured than a charity fund. Some black churches in the 20th century went well beyond the informal housing assistance described in an earlier section of this account, and built explicit lending programs, formal mortgage funds governed by church boards, and congregation-backed loan structures that functioned, for the families they served, as community banks operating under a steeple rather than a sign. The theological grounding for this kind of economic activism was not difficult to establish within black Protestant traditions that had always understood the church's mission as encompassing the material conditions of its members' lives, rather than confining itself to spiritual matters alone. A congregation that tithed to support a pastor, maintain a building, fund a school, and sustain a benevolence fund for members in distress, was a congregation that had already accepted the principle that pooled religious giving could serve practical community purposes. Extending that principle to include housing finance required only the recognition that a family's ability to own a home was as much a matter of community well-being as its ability to bury its dead with dignity or educate its children adequately. The mechanisms that different churches developed varied considerably in their formality and their scale. At the most informal end, a board of deacons or trustees might maintain a discretionary fund from which interest-free loans were made to members for specific purposes, including down payments, closing costs, or the bridging of gaps between what a buyer had saved and what a transaction required. These loans were documented internally, repaid on schedules set by the board, based on the borrower's circumstances, and governed entirely by the church's own sense of accountability to its members. No outside institution was involved, no credit check was run, and the decision about whether to lend was made by people who had known the borrower for years. At a more formal level, some churches created designated housing funds that operated with explicit governance structures, application processes, and written agreements between the church and the borrowing family. These funds drew from dedicated tithing campaigns, from bequests made by members who wished their savings to continue serving the community after their deaths, and from contributions by church members who had already achieved home ownership and understood what the absence of accessible financing had cost families who came after them. The fund would set terms, including repayment schedules, and the conditions under which a loan would be forgiven or restructured, and would track its lending activity in formal records maintained by the church treasurer. The social accountability built into congregation-backed lending was, in many respects, more effective than the accountability structures of formal financial institutions. A borrower who fell behind on payments to a community fund was not dealing with an anonymous servicer who would initiate foreclosure proceedings after a fixed number of missed payments. They were dealing with people they saw every Sunday, whose children attended the same Sunday school, whose opinions of them mattered in ways that went far beyond any financial transaction. That social pressure worked in both directions. It encouraged borrowers to meet their obligations even when circumstances made it difficult, and it encouraged lenders to restructure obligations when circumstances made strict repayment genuinely impossible rather than merely inconvenient. The modern example of the California congregation that raised more than $300,000 for interest-free homeownership loans was not an innovation. It was a continuation, in contemporary form and with contemporary documentation, of a practice that Black churches had been developing for generations. What was different in the modern instance was the formality and the visibility, the fact that the program was publicly described, externally documented, and capable of attracting contributions from outside the congregation itself. The underlying logic, that a faith community's pooled resources could be directed toward permanent homeownership for families the mainstream market refused to serve, was as old as the first church that quietly helped a member make a down payment and asked only for repayment when the family could manage it. What these programs demonstrated, across all their variations, was that the church's financial power was not incidental to its community role. It was central to it. The institution that could mobilize a community's moral commitment could also mobilize its material resources, and in communities where moral commitment and material need were both concentrated in the same building on Sunday morning, the distinction between spiritual mission and economic mission was always thinner than the wider culture chose to acknowledge. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. Church mortgage funds turned faith into finance, building formal lending structures from the same community bonds that filled the collection plate every Sunday. The next story moves away from institutions entirely, into the informal world of character-based lending, where the currency was not money, but reputation, and where knowing a person well enough was the only underwriting that mattered. Section 21. Character-based lending and the currency of reputation. Before credit scores existed, before standardized loan applications had been designed, before the machinery of modern financial assessment had been built and calibrated and embedded in the infrastructure of American banking, people lent money to one another on the basis of something simpler and, in many ways, more accurate. They lent it to people they knew. The judgment they applied was not algorithmic, it was accumulated. It drew on years of direct observation, on the knowledge of how a person had behaved in previous difficulties, on the testimony of people whose own judgment was trusted, and on a community's collective memory of who had kept their word and who had not. This form of assessment, which financial historians sometimes call character-based lending, was the dominant model of credit evaluation in American communities before the standardization of the 20th century, and in Black communities that had been excluded from that standardization, it remained the dominant model long after. The exclusion that made character-based lending necessary in Black communities was not only the exclusion from banks and formal mortgage lenders. It was also the exclusion from the credit reporting systems that those lenders relied on. A Black family that rented faithfully for 20 years, paying every month without exception, built no credit history that any mainstream lender would recognize, because rental payments were not reported to credit bureaus in the way that mortgage payments were. A Black worker who borrowed from his lodge and repaid every cent on time demonstrated nothing to the outside financial system, because the lodge's records were not legible to that system. The formal economy had been designed to recognize certain kinds of financial behavior and to remain blind to others, and the kinds it was blind to happened to be the kinds most common in Black communities. Character-based lending saw through that blindness because it did not depend on the formal system's records at all. The lender in a character-based transaction might be a neighbor, a church member, a lodge brother, an employer, or a community figure whose own resources were sufficient to bridge the gap between what a borrower had saved and what a purchase required. The assessment process was entirely relational. A man who wanted to borrow money toward a down payment would approach someone in his network with the resources and the inclination to help, and that person would draw on everything they knew about him in deciding whether to say yes. How had he handled difficulty in the past? Had he ever walked away from an obligation when it was hard to meet? Did the people who knew him best speak well of him? Was his reputation in the community the reputation of a man whose word meant something? The answer to those questions, assembled through the informal testimony of a network rather than through any documented process, constituted an underwriting decision that was, in many cases, more accurate than what a credit score would have produced. Studies of black homeownership in the early 20th century have found default rates in black neighborhood lending that challenge the assumptions built into the discriminatory appraisal systems of the era. The black borrowers that redlining declared too risky were, in measured practice, repaying their loans at rates that compared favorably with borrowers in the neighborhoods that the same system had declared the safest investment. The character-based assessment that community lenders were applying was not a soft substitute for rigorous evaluation. It was, in many instances, a more rigorous evaluation of the actual likelihood of repayment than anything the formal system was doing. The community figures who served as character witnesses in these transactions occupied a particular kind of social role that has no clean modern equivalent. A pastor who vouched for a congregant's reliability, a lodge master who confirmed a member's standing, a longtime employer who testified to a worker's honesty and consistency, were each performing a function that the formal credit system had outsourced to numbers and algorithms. Their testimony carried weight because their own reputations were bound up in the accuracy of what they said. A pastor who vouched for someone who then defaulted suffered a reputational consequence that gave him a strong incentive to be honest in his assessment. The accountability was distributed through the community, rather than concentrated in an institution, which made it less uniform, but often more responsive to the actual complexity of a person's financial situation. What character-based lending could not do was scale. It worked within the boundaries of direct personal knowledge, which meant it worked best in communities that were stable and dense, where people had known each other long enough to have accumulated the observational record on which accurate character assessment depends. It worked less well for newcomers, for people who had recently arrived in a city and had not yet built the relationships that would make them legible to the community's informal assessment network. The Great Migration created exactly this problem for millions of black families who arrived in northern cities as strangers and had to spend years building the relationships that would eventually give them access to the informal credit systems that established community members could already draw on. But within its natural boundaries, character-based lending moved real money and real families into real homes, operating entirely outside the formal system that had decided those families did not merit its services. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. Character-based lending replaced the algorithm with accumulated knowledge, and in communities where the algorithm had been designed to exclude, that substitution was not a compromise but an improvement. The next story follows a tradition older than any of the formal institutions described in this account, the giving circle, which pooled community resources under collective governance and directed them toward the goals the community itself decided mattered most. Section 22. Giving Circles and the Collective Down Payment. The giving circle is not a modern invention, though the name has become more common in recent decades as the practice has attracted attention from researchers and philanthropists interested in how black communities direct their charitable giving. The underlying structure, a group of people who pool contributions and collectively decide how to distribute the resulting fund, is older than any formal financial institution, and has roots that reach back through Black American mutual aid tradition all the way to the communal economic practices of West African societies that survived the Middle Passage in the memories and habits of enslaved people. What has changed over the centuries is the scale, the formality, and the explicitness of the purpose. But the essential mechanism has remained constant. People who share a community and a set of values pool their resources and direct them collectively toward goals that none of them could reach individually. In the context of homeownership, giving circles operated as a supplement and sometimes as an alternative to the more structured savings mechanisms described elsewhere in this account. A group of women in a church auxiliary, a cohort of members in a fraternal organization, a cluster of families in a neighborhood association might agree to pool a fixed contribution each month into a designated fund, governed by rules the group itself had set, and to direct the accumulated sum toward a specific purpose. A down payment for a member who had been saving toward a home purchase, a closing cost gap that was threatening to collapse a transaction, or a repair fund for a member whose property needed work that would otherwise force a sale. The governance structure of a giving circle was, and remains, one of its defining features. Unlike a susu, in which the distribution order is set in advance, and the fund rotates automatically, a giving circle typically involves collective deliberation about who receives the pool in any given cycle. Members present their situations, the group discusses, and a decision is made collectively. This deliberative structure introduced a social accountability that was different from the automated rotation of the susu, because the recipient had to make their case to the community, and the community had to agree that the case was compelling. The process was more demanding on both sides, and it produced a different kind of relationship between the fund and the people it served. Black women's organizations were particularly important in developing and sustaining this tradition. The club movement that grew in the late 19th and early 20th centuries, through organizations like the National Association of Colored Women, founded in 1896, created a national network of black women's clubs that engaged in what their members called racial uplift work, meaning the practical improvement of community conditions through organized collective action. Housing was central to that work. Club members raised funds for community housing projects, provided assistance to families navigating hostile real estate markets, and operated giving circles within their local chapters that directed pooled contributions toward homeownership for members who had identified properties but lacked the final resources to close. The tradition carried forward through the sorority system that developed in black colleges in the early 20th century. The 8 historically black sororities that formed the National Pan-Hellenic Council, established in 1930, built alumni networks that operated as giving circles in the original sense, pooling the resources of professional black women toward community purposes that included housing assistance. A sorority chapter in a major city might maintain a housing assistance fund, operate a scholarship fund for members pursuing homeownership education, or collectively sponsor a member's down payment as a loan to be repaid into the fund for the benefit of the next recipient. What the Giving Circle added to the ecosystem of black homeownership strategies was democratic governance of community capital. Every other mechanism described in this account, from the susu to the church mortgage fund to the character-based loan from a community figure, involved some asymmetry of power between the resource holder and the resource seeker. The Giving Circle was the mechanism that came closest to eliminating that asymmetry, because the members of the circle were simultaneously the contributors to the fund and the potential recipients of its distributions. Everyone had an equal voice in the decisions, and everyone had an equal stake in the outcomes. The community governed its own capital, rather than delegating that governance to an institution or an individual. That democratic quality made giving circles resilient in ways that institution-dependent strategies were not. When a black-owned bank failed, its depositors lost access to their funds and had to find another institution. When a giving circle's members moved away or circumstances changed, the circle could reconstitute itself around a new set of members with minimal friction, because the mechanism existed in the relationships between the members rather than in any external structure. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. Giving circles put democratic governance at the center of community capital, letting the community itself decide who received its pooled resources and on what terms. The next story moves to the campuses of historically black colleges and universities, where a professional class was being trained that would carry the habits of collective financial support into the neighborhoods where they eventually settled. Section 23, HBCU Networks and the Professional Class Pathway. Howard University in Washington, Fisk University in Nashville, Spelman College in Atlanta, Morehouse College across the street from it, Hampton Institute in Virginia, Tuskegee in Alabama, and more than 100 other historically black colleges and universities spread across the country, represented something that the wider American educational system had not been designed to produce: a deliberate, sustained effort to create a black professional class in a society that had structured itself to prevent exactly that. The men and women who graduated from these institutions between Reconstruction and the Civil Rights era emerged into a world that was still largely hostile to their ambitions. But they emerged with something that made navigation of that world considerably more possible: credentials, networks, and a community of peers who had been trained to support one another's advancement in an environment that would not support it from the outside. The HBCU network was a financial network as much as an educational one, though it was rarely described in those terms. Alumni associations maintained connections between graduates across cities and decades. Professional fraternities and sororities rooted in HBCU campuses, including the Divine Nine organizations of the National Pan-Hellenic Council, created structured communities of Black professionals who shared information about economic opportunities, made introductions across cities, and pooled resources for collective purposes, including housing assistance. A Black doctor who graduated from Meharry Medical College in Nashville and moved to practice in Detroit arrived in that city as a stranger. But he arrived as a stranger with connections, because the Meharry alumni network in Detroit included people who knew which neighborhoods were accessible to Black buyers, which local institutions were worth dealing with, and which community figures could facilitate a purchase that no bank would finance. The professional class that HBCUs trained became, in many communities, the backbone of the informal financial infrastructure that supported Black homeownership. Black doctors and lawyers who earned incomes that permitted genuine accumulation of savings became the character lenders and the private mortgage holders that earlier sections of this account have described. They were the people with enough capital to carry a note on a property sale, to bridge a financing gap for a family they knew, to guarantee a loan at a Black-owned bank by pledging their own assets as additional security. Their willingness to use their economic position in service of community homeownership was not universal, and the history of Black professional class detachment from working-class community needs is a real and complicated story. But the pattern of HBCU-trained professionals using their resources and networks to facilitate homeownership for families around them is also real, and it operated as a significant mechanism in cities across the country. The dental school at Meharry, the law school at Howard, the schools of education at dozens of HBCUs produced graduates who became, among other things, the real estate agents, the insurance agents, the lawyers who drew up private mortgage documents, and the accountants who helped families structure transactions in ways that minimized their legal exposure in a hostile market. These were professionals whose skills were directly applicable to the housing challenges their communities faced, and the HBCU networks that connected them to one another made it possible for those skills to circulate through the community in ways that a purely individual private practice could not have achieved. Booker T. Washington's vision for Tuskegee Institute, whatever its limitations and however fiercely it was contested by Du Bois and others, included a practical dimension that bore directly on homeownership. Washington believed that skilled trades, disciplined saving, and the ownership of property were the foundation on which Black economic independence had to be built, and the curriculum at Tuskegee was shaped accordingly. Graduates who came out of Tuskegee with practical building and agricultural skills were graduates who could, in some cases, build their own homes rather than purchase them, reducing the capital required to reach home ownership and bypassing the lending system entirely. The tradition of self-built homes in Black communities, documented in various parts of the rural South and in some northern urban areas as well, was an expression of exactly this logic. The HBCU network also produced the teachers who staffed the Black schools, where financial literacy, however informally transmitted, was part of the education that students received. A generation of Black students learned from Black teachers, who themselves owned homes, had navigated the challenges of Black homeownership, and understood from direct experience what strategies were viable and what pitfalls to avoid. That transmission of practical knowledge through educational networks was not quantifiable in the way that a mortgage is quantifiable, but it shaped the financial behavior of communities in ways that accumulated over decades into measurable differences in homeownership rates. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. HBCU networks built a professional class that carried community financial knowledge across cities and generations, turning education into an infrastructure for homeownership as much as for individual advancement. The next story moves into the spaces where that knowledge circulated most freely, the barbershops and beauty parlors that served as the informal financial information exchanges of Black community life. Section 24. barber shops, beauty parlors, and the information economy of black home ownership. There is a particular kind of institution that every black community in America has known intimately, and that the wider culture has always understood as something other than what it actually was. The barbershop and the beauty parlor were, on the surface, places where hair was cut and styled, and where an hour or two passed pleasantly in the company of neighbors. Beneath that surface, they were something considerably more complex and considerably more consequential. The informal information exchanges of black community life, the places where the knowledge that shaped economic decisions circulated freely among people who trusted each other enough to speak plainly about money, property, opportunity, and risk, in a world that was trying to keep all of those things out of their reach. The barbershop occupied a specific social position that made it uniquely suited to this function. It was one of the few spaces in black community life that was consistently accessible to men across class lines, where the doctor and the laborer sat in adjacent chairs and waited their turns in the same room. The barber himself, who had been cutting the same customer's hair for years and decades, accumulated a knowledge of the community's financial landscape that was both broad and deep. He knew who owned property and who was looking to buy. He knew which properties were coming available and which sellers might be open to terms. He knew which institutions were worth dealing with and which had treated community members badly enough to be avoided. He knew, in some cases, who had money to lend and who needed to borrow it, and he served, without any formal authorization or compensation for the function, as a matchmaker between the two. The beauty parlor served the same function in the lives of black women, with some differences that reflected the different economic position and different social networks of black women in American community life. Where the barbershop was a daily or weekly gathering place for men of varied economic standing, the beauty parlor was a space where black women, including the domestic workers, the teachers, the nurses, and the church leaders who formed the backbone of black community organization, gathered regularly and talked with a frankness that the social constraints of more public settings did not always permit. The conversations that happened under dryers and between appointments included detailed practical discussions of housing markets, landlords, sellers, and financial strategies that amounted to a continuous community seminar on the economics of black homeownership. This information function was not incidental to the barbershop and beauty parlor's role in community life. It was inseparable from it. The trust that made frank economic conversation possible in these spaces grew directly from the intimacy of the physical relationship between barber or stylist and customer, which is among the most personal and consistent relationships in most people's lives, and from the social accountability of a space where everyone present was known to everyone else, and reputations were maintained in full view. A person who gave bad advice in a barbershop, who steered a neighbor toward a predatory deal, or vouched for an untrustworthy seller, faced immediate social consequences in the same space where they received their haircut every week. The accountability was built into the architecture of the relationship. The specific information that circulated through these spaces was exactly the information that formal institutions withheld from black families. Which neighborhoods were actually accessible to black buyers, as opposed to which neighborhoods the real estate agents who worked with white sellers would show them. Which sellers were open to carrying a note rather than requiring cash financing. Which community figures had resources and a history of lending them within the community on fair terms. Which lawyers could be trusted to draw up a private mortgage correctly. Which building and loan associations were sound and which were struggling. Which title companies would handle transactions in black neighborhoods without adding discriminatory charges. This was the granular, local, current knowledge that made navigation of a hostile housing market possible, and it was too specific and too rapidly changing to be captured in any newspaper column or organizational publication. It lived in conversation, and the barbershop and beauty parlor were where conversation lived. The barber who knew the community's financial landscape also sometimes participated directly in its transactions. Barbers who had built their own shops, accumulated some savings, and established themselves as trusted community figures were sometimes among the informal lenders described in earlier sections of this account, extending small loans to regular customers toward specific purposes and collecting repayment In the same cash economy way, they conducted their own business. The beauty parlor operator who owned her shop and her building was often a source of similar informal credit, and the knowledge she maintained of her customers' circumstances made her a more accurate assessor of creditworthiness than any institution working from a paper application. The information that flowed through these spaces also included warnings, which in a market designed to exploit black buyers were as valuable as any positive guidance. Word of a predatory contract seller, of a landlord who raised rents the moment a neighborhood began to change, of a title company that had cheated a community member, traveled through barbershop networks with a speed and a reliability that no consumer protection agency could match. That informal warning system prevented an unknown number of families from walking into transactions that would have cost them everything they had saved, and it did so entirely through the circulation of community knowledge in a space that the outside world saw as nothing more than a place to get a haircut. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. Barbershops and beauty parlors turned community trust into financial intelligence, circulating the knowledge that made homeownership navigable in a market designed to confuse and exploit. The final story draws all of these threads together, tracing what 24 separate strategies, built outside the institutions that refused to help, ultimately meant for the families who used them and for the communities they left behind. Section 25. What was built and what it means. Pull back far enough from any single strategy described in this account, and a pattern emerges that is larger than any of its parts. The Sioux and the Mutual Aid Society, and the Building and Loan Association, and the Church Mortgage Fund, and the character-based loan from a lodge brother, and the domestic workers' 20 years of disciplined saving were not separate phenomena that happened to occur in the same communities at the same time. They were expressions of a single underlying response to a single underlying condition. Black families in America had been systematically excluded from the institutions through which most Americans built economic stability, and in response, they built their own institutions, their own mechanisms, their own parallel economy of trust and collective resource, and they used it to get into homes that the official system had decided they were not permitted to have. The scale of what was accomplished through these methods is not easily captured in a single number, but some figures give a sense of it. Black homeownership, which stood at roughly 23% in 1940, had risen to approximately 38% by 1960, a period of significant, if unequal growth, that occurred despite the continued operation of redlining, restrictive covenants, discriminatory GI Bill implementation, and the full range of exclusionary mechanisms that federal and private institutions were deploying against black buyers during exactly those years. That growth happened because of the strategies described in this account, because of rotating savings circles and black-owned thrifts and insurance company mortgages and fraternal lodge credit unions and church funds and the informal lending networks that moved quietly through barbershops and church basements and lodge meeting rooms across the country. What those homes represented went beyond the financial. A family that owned its home had something that a family paying rent to a landlord did not have. And the difference was not only economic, though it was powerfully economic. It was also psychological, social, and generational. Ownership meant that a landlord could not raise the rent to force a family out of a neighborhood that was becoming more desirable. It meant that the children who grew up in that house grew up with a different understanding of what was possible, an understanding grounded in the daily experience of living in something that belonged to their family, rather than to someone else's. It meant that when the parents died, there was something to pass on, an asset that the next generation could borrow against, sell if necessary, or simply keep as the foundation on which their own economic lives could be built. The racial wealth gap that exists in America today is, in large part, the compounded result of the homeownership gap that was engineered through the policies described in the first section of this account. The median white family today holds many times the wealth of the median black family, and a substantial portion of that difference traces back to the decades when white families were being handed subsidized mortgages, low-cost entry to appreciating suburban neighborhoods, and government-backed pathways to homeownership, while black families were being turned away from all of those things. Every generation of homeownership that white families gained during those decades produced equity, and that equity compounded forward through inheritance and opportunity in ways that continue to shape the present. Against that background, the strategies in this account have to be understood honestly, which means acknowledging both what they achieved and what they could not overcome. The families who used these methods and reached home ownership built something real and something valuable. But they built it under conditions that ensured it would be worth less, in dollar terms, than the equivalent effort applied in the neighborhoods that the federal government had decided to subsidize. A home purchased through a black building and loan in a red-lined neighborhood appreciated more slowly than an equivalent home purchased with an FHA-backed mortgage in a green-lined suburb. The equity accumulated was real, but compressed. The generational advantage it conferred was genuine, but diminished by the market conditions that discriminatory policy had created around it. That honest accounting does not diminish what was built, it places it in context. The families who saved in Susu circles and borrowed from church funds and purchased through black insurance companies and navigated the hostile terrain of the mid-century housing market were not working with a full deck. The deck had been deliberately arranged against them. What they accomplished with the cards they were dealt reflects a financial creativity, a communal discipline, and a long-term orientation toward their children's futures that deserves to be understood in its full complexity, rather than reduced to a simple story of triumph or a simple story of victimization. The 24 methods described in this account are not museum pieces. Some of them are operating today, in updated forms, in communities across the country. Community land trusts have expanded significantly in recent decades. Giving circles and susus remain active in black communities and in immigrant communities that face some of the same barriers that black Americans have always faced. Black credit unions continue to operate on the character-based lending principles that their predecessors established a century ago. Church mortgage funds have been formalized and documented in ways that make them more visible, without making them fundamentally different from what they have always been. The tradition is alive, because the need has never entirely disappeared. What changes, when these strategies are understood as a connected body of practice, rather than a collection of separate workarounds, is the way the history looks. Black families did not simply suffer exclusion from the American housing market. They built, in response to that exclusion, one of the most sustained and inventive traditions of community-based financial innovation in American history. They did it without recognition, without subsidy, and without any guarantee that what they built would not be taken from them by violence or law, or the slow erosion of a market rigged against them. They did it generation after generation, passing the knowledge through barbershops and church basements and fraternal halls and kitchen tables, because the alternative was to accept a condition that no generation was willing to accept as permanent. The homes that resulted from all of this effort were more than buildings. They were arguments, made in wood and brick and mortgage paper, against the proposition that black families did not belong in the ownership class of American life. 25 ways of making that argument, each one a door that someone found, or built, or forced open when the official entrance was barred. If you enjoyed this video, make sure to subscribe. Thanks for watching, and I'll see you in the next one.